My name is Johann Hattingh. I'm Chief Editor of IBFD's Bulletin for International Taxation. The journal this year celebrates its 75th anniversary, having been founded in 1946. And this November, there'll be a special issue on the theme of 75 years of international taxation, looking back and looking ahead. Today, I'm very fortunate to have with me one of the authors in this special issue, Professor Reuven Avi-Yonah, who's Irvin Conn Professor of Law at the University of Michigan in the US. And he has written a wonderful, thought-provoking piece under the title, The International Tax Regime at 100, Reflections on the OECD's Base Erosion and Profit Shifting Project. Welcome, Reuven.
Thank you.
If I can start and ask you what motivated you to write on this topic?
So, I think it's clear to everybody that this proposal that was just more or less finalized this month and will be no doubt further elaborated in the next couple of years is the most distinctive and maybe even revolutionary change in international tax in the last century. Really since 1923 when it all started. So I thought that's the obvious thing to write about for a 75th anniversary edition of the Bulletin. And in addition, I thought that it's, I'm a historian by training. And so I thought it's always interesting to do periodization in history. And one of the big questions is, when there's a revolution, how much of it is really new and how much of it depends on what happened in the past. And invariably you find out, like Sister Tocqueville wrote about the French Revolution, that every revolution has historical roots in the past because nothing is ever completely a blank slate. So I thought it would be interesting to investigate the intellectual roots of some of the changes of Pillar 1 and Pillar 2 are proposing to make in the international tax regime.
Yes, and I think that is very distinctive in your article. I think it's fair to say that it challenges the idea that Pillar 1 and Pillar 2 and its key design elements are original. So I wonder if you could explain, if we start with Pillar 1, where you think some of those key aspects come from, where do they originate?
So the key conceptual innovation in Pillar 1, there's a lot there, but the key conceptual innovation is Amount A. And Amount A is about essentially taking a formulary approach, discarding the permanent establishment threshold, discarding the arm's length standard for that particular amount, and then allocating it essentially where the revenue comes from, that is where the sales happen in the market jurisdiction. And this, I think, can be traced back to the way the US states did formulary apportionment going all the way back to, again, the 1920s, because they always use a sales factor. That is, they traditionally used production factors as well, such as payroll and asset, but they always use a sales factor. And in recent years, they've more and more established, there was a move towards more use of the sales factor, so that more than half of them use only sales in the formula. And this is, of course, similar to the way the VAT works on a destination basis. And the reason is simple. Well, there are two reasons, really. One is, of all of these three factors, assets, payroll, and sales, it's the sales that is the consumer base that it's the least mobile. It's easy to move assets and jobs around, unfortunately, and this is in fact one reason why countries don't like to tax those, because they worry that they will go elsewhere if they tax them. But the sales, the consumer base is immobile. And the other reason is that at least politicians believe that it's a great idea to tax imports and exclude exports, which is basically what this is doing. So all the way back in 1993, which was really my first academic article, written around the whole debate that was back then raging in the US around formulary apportionment versus the arm's length standard, I suggested that one of the big problems of the formula always was, what about if different countries use different formulas and then you get double taxation? And I said, well, if we do only sales-based formula, then there is a natural pressure and a natural tendency for all states to move in this direction. So I suggested that, and then I repeated that in various occasions. And then eventually, I wrote an article with Kim Clausing, who's now in the Treasury, and Mike Durst, who used to be in the Treasury before that, suggesting that maybe there is a compromise solution possible between the arm's length standard and formulas where you take some kind of fixed return for fixed assets, just like as is done now, basically for amount A, and then the residual where there are no comparables and you can't really prove whatever the result is might be arm's length because you can't prove what unrelated parties would have done had they been negotiating at arm's length. Well, that should be allocated by formula to the market jurisdiction. So this was done in 2009, and it's generally accepted that this was one of the intellectual origins of this whole discussion in BEPS and amount A and so on. So I think that that's where this may be coming from. And so the roots go all the way back to the period when international tax regime was formulated, but it's really in the last 20 years or so that this has become a major issue in the discussion.
It's interesting that you bring up the question of consumption, and we'll probably get back to that. But I should also say in the 1980s and 90s, the discussions in the US about state taxation and formulas spilled over into the pages of the Bulletin, and we had several contributions and reactions from people in Europe and elsewhere to ideas originating in the US, and we seem to have come to that point again today. I wanted to ask you about sales as a proxy, because we're essentially dealing here with profit taxes. How appropriate is it? You raised the question of consumption taxes, and we seem to have been moving between the two in these discussions.
So, I mean, it's easy to say consumption taxes should be levied in the country where consumption takes place. That's obvious. It is more, this has always been an issue. Is it legitimate to tax profits in the country where consumption, in the sales country, in the market country? Now, I would be the last person to say that allocating everything according to sales is accurate in any way. It certainly is not related to value creation according to, you know, the BEPS formula. So it was always suggested as an administrable solution to the problem rather than as a correct solution. However, in this particular context, one needs to remember that it's only 25% of the residual profit that gets allocated to the market country. Presumably the other 75% will be taxed somewhere else, which is where the production takes place. So if you look at it that way, then it's not so unreasonable to suggest, because I've always been of the opinion, and this is actually something that can be found already in the 1923 For Economists report, that without sales, there is no profit. And you can't just say everything belongs to the production country and nothing belongs to the country of the market. I don't think that's a reasonable position to take. In the countries of the market, I mean, this whole thing started, of course, the modern iteration from the digital economy and the problem of Facebook and Google and Amazon and Apple, et cetera, deriving tremendous profits from countries where they use the market, or they use the data derived from the market, or they use something else. And countries under the current rules cannot tax them because they don't have a PE. So I think that from that perspective, these countries correctly feel that something should belong to them for the use of their customers' data, for example. And this is a political compromise, a 75-25. Personally, I would have preferred something closer to 50-50, right? But, whatever the politicians agree, that's the politicians agree. And, we have to live with it, right?
Indeed, here in Africa, the African Tax Administrators Forum have claimed that 100% should go to the market jurisdiction. Well,
okay, so obviously there's room for disagreement, right?
Indeed. Something that caught my eye in your article is the reference to administrability of these rules, and I think it comes through in your early work as well, where you say, well, you need to take account of administrability, and looking at sales is obviously much easier than trying to find out the intricacies of profit creation. And I wanted to ask, do you think that is still so important today with the whole network of information exchange agreements, country by country reporting? Any thoughts on whether that movement around information has potentially shifted administrability questions?
Look, I think there are two things that can be said about this. There's no question that as far as the whole problem of individual taxation and tax evasion, the information exchange agreements are tremendously important. The growth of the common reporting standard and all of that really does lead us to hope that the scope of international tax evasion, which is, just illegal, but is hidden, as the Pandora Papers again showed for the zillionth time, may be reduced somewhat. And I found it interesting that there are very few Americans in either the Pandora Papers or before that the Panama Papers, et cetera, because we have FATCA, and FATCA is to some extent the origin of this, and it's one of the stronger regimes that are out there. But setting that aside, here we're talking about corporate taxation. And I have to say, despite the rise of country-by-country reporting, country-by-country reporting is useful in showing the disparity between profit reported and things like assets and payroll in the country. And where the disparity is large, you suspect that there's something wrong there. But it doesn't really answer the question of how much belongs in each country. And to do that, you need to either do arm's length transfer pricing, but I think all the experience has shown that this is almost impossible to do because most multinationals exist because they have unique advantages that cannot be replicated at arm's length. So if you leave that aside or restrict it to the stuff that can be done easily, then you got this question of how to allocate the residual, and the residual is most of the profit for the, these are only, remember, this only applies to large multinationals, and it only applies to multinationals with a profit margin of over 10%. So it's really fewer than 100 companies probably qualify for this. It's supposed to go down if it works, right? But for now, it's fewer than 100 companies. And for them, they really have this, I think economists would call this rents from their intellectual property that cannot really easily be assigned, because part of the issue is the reason that they keep them inside the multinational is precisely this, that if somehow the algorithms were to escape, then the residual will disappear because there will be too much competition. So given that, I think that there's no correct way of allocating it. And if there's no correct way of allocating it, you really need to focus on questions like administrability. And I think this solution, at least I think, is administrable. And it's also administrable, and this was always important to me, by countries that don't have a very sophisticated tax administration. VAT notoriously is administrable by countries that don't have a very sophisticated tax administration. That's why it's the most popular tax in the world and also the highest revenue raising, because fundamentally you can trace sales, even for services, certainly for goods, and you can allocate based on that. And that's not, the calculation is not that difficult. You take the profit and you multiply it by the number of sales in your country compared to global sales and so on, the way that Pillar 1 works. And I think that most countries should be able to do this. We will see. This is an experiment, but I do think that we need to try.
Very good. If I can then move on a bit to talk about your thesis on Pillar 2, which is equally interesting. Can you briefly explain where you think the intellectual origin of Pillar 2 lies?
Okay, so this is what I call the single tax principle, and other people call it differently. I agree that my choice of terminology was not perfect back in 1997 because it focuses people too much on the question of single versus double taxation, which is not what this is about. And Ruth Mason has recently called it full taxation, which is probably true. But the basic idea is that there are two principles underlying the international tax regime. One is the tradition of compromise that was reached in 1923, where the active income is allocated primarily to the source country and the passive income primarily to the residence country. Fine. But then the question becomes, what happens if the primary taxing jurisdiction doesn't tax? That is, if there's no source tax for the active income or no residence tax for the passive income. And my answer has always been, well, then the other jurisdictions will tax, because we don't want double non-taxation. We don't want zero taxation situations for all kinds of reasons. Now, this, I think, also goes all the way back to the beginning, because that was the justification of the United States in 1918 for not allowing an exemption and instead adopting the foreign tax credit, first in the world, because they said if an exemption system exists, which is what most countries did back then if the source country does not tax, then there's simply no tax because the residence country doesn't tax either. So they adopted the foreign tax credit, which says if there's no tax in the source country, then there is no credit, and therefore the residence country will tax. And then you see the same idea in the 1927 commentary on the first League of Nations model, which says explicitly that you want to try to prevent both double taxation and double non-taxation. But I think in practice, this was more a theory than a fact. When it started becoming a fact was in the 1960s, and this is really attributable to one person, which is Stanley Surrey, who was the first U.S. Assistant Secretary for Tax Policy. And he, even before he got into the government, had this idea that there shouldn't be double non-taxation. And for example, he testified against the Pakistan Treaty because it has tax sparing. And he said tax sparing is wrong because that is double non-taxation, clearly by definition. And so the US Senate refused to ratify the treaty. And ever since then, this had been a set part of US treaty policy that we will not give tax sparing credits to anybody. So then when he got into government in the 1960s, he started doing two things. First, he enacted Subpart F, which is our CFC rule, which was again the first in the world. And CFC rule back then was premised on the idea that if there is no source taxation, the residence country should tax, and that's how it was structured. And then he also negotiated treaties like the treaty with Luxembourg and some others, where it said if the residence country does not tax effectively, then the US as the source country can levy a withholding tax. So I think that it's pretty clear that he was the practical originator of this idea. But then again, the problem was that until recently, countries, including the United States, did things that are completely inconsistent with this. I mean, in 1984, we enacted the portfolio interest exemption, which says we're not going to tax interest regardless of whether it's taxed at residence. And that was bad. And then it got worse when we enacted check the box in 1997, which basically meant that, Subpart F, the CFC rules, could not operate properly. And so for a long time, I thought, well, this is not going anywhere. And when I wrote my 1997 article about it, this was exactly at the same time that we adopted check the box. So it wasn't great timing. But eventually, I think the world started seeing it in the same way, especially post the 2008 financial crisis. And even BEPS 1, the first edition, 2013, 2015, had that element behind it, for example, in Action 2, which is the hybrid rules, and Action 3, which is strengthening CFCs, but none of these were kind of a universal application of the rule because they were not binding, et cetera, et cetera. So now I think with Pillar 2, it's possible to imagine a world in which at least minimum corporate taxation will actually work. And the fundamental reason that I think this should work is, first of all, because it really depends on agreement among a much smaller number of countries. It's always been clear to me that as far as active income is concerned, yes, in theory, it should be taxed in the source country, but there's so many source countries that it's almost impossible to coordinate. There are only the G20 are basically the residence country of all the big multinationals. I mean, it's very hard to find a big multinational that's not headquartered in the G20. So if they agree, and they obviously agree, and they impose this minimum tax on everybody, then developing countries can really say to multinationals, your threat of going elsewhere if we don't give you a tax break is empty because we know that you're subject to this 15% minimum tax. So we might as well collect a 15% minimum tax because you'll get a credit for it in the home country. And I think that's the way it should be done. I've never believed that developing countries really choose to give these tax breaks to multinationals, because I've been involved in too many situations where the multinationals does this auction, where they say, well, we have X number of jurisdictions where we can make the investment, and we will go elsewhere unless you give us a tax break. And the result, of course, is that they get it in both places. That's usually what happens. And now, hopefully, that won't happen again. So there are things that I'm not happy about with this, again, political compromise. I think 15 is way too low. I think we should aim for something like the OECD average, which would be more like 25%. And then, give foreign tax credits to source countries, etc. But again, you have to start somewhere. My hope is that if the US this year possibly will strengthen the GILTI rules to increase the rate, which at the moment is only 10.5%, but everybody agrees it should be raised to at least 15, but I hope they will raise it to something like what the Biden administration is proposing, which is more like 25. That may lead other countries to go along because, if the US multinationals are subject to that. And I've never bought the thesis that there's something uncompetitive about that, simply because the US multinationals have always done really well. So taxing them on worldwide profit, especially since I really do believe that these are economic rents, so they're going to collect them regardless of what you do. This is not, doesn't going to have an adverse behavioral impact. So that's I think where Pillar 2 is coming from.
Yeah. Well, that's really fascinating. It struck me, and I think you're correct in saying that you need to look at the G20 countries when you consider Pillar 2. My question is, how do you square the idea of the single tax principle with their sovereignty? Because there clearly are countries in that grouping who might not want to sign up or also enthusiastically sign up, especially if the rate would be higher.
So, look, I mean, I think fundamentally every country obviously is sovereign, can do whatever it wants as far as its own taxes are concerned. But here we're talking about taxation by the residence country of multinationals. And I still think that even though we've been moving towards more source taxation, and some people say, well, the residence country is not very meaningful, I still think that even in today's world, where the headquarters are is a meaningful concept. And it's not so easy to move them around. I mean, it is notable. I mean, the one country that had a plague of what we call inversions, that is movement of multinationals, is the United States, because we base corporate residency purely on place of incorporation and not on the location of the headquarters. But what was always striking to me, that with all of these inversions, not a single company ever moved its actual headquarters out of the United States. I mean, they put their nominal parent company somewhere else, but they always left the headquarters in the US, and the CEO and the CEO's family and everybody else all lived in exactly the same place that they used to live. And in places like Europe, you can't do that because you've got corporate exit taxes, which the European Court of Justice has said are perfectly legit. So I think that that's meaningful. And I also believe that multinationals are unitary enterprises, and therefore it's meaningful to tax them as a global enterprise in a united basis. And so it's natural to say that the residence country has the right to tax its multinationals on global income, as long as it gives foreign tax credit. So at that point, the choice is of the source country, and the source country can decide we don't want to tax, and the source country can decide we do want to tax. I think given the availability of a foreign tax credit in the residence country, it would be silly for the source country not to tax, but that's their sovereign choice. If they don't want to tax, they won't tax. But it is also the residence country's sovereign choice to tax its multinationals on global income. And that's been established since 1962, since the CFC rules. Now, I think back then, you could have made an argument that this is somehow an extraterritorial reach. And in fact, I wrote an article about that, suggesting that back then you could have said that the deemed dividend approach, which is what the United States does for CFC rules, and most countries don't do it this way. They just look through, which I think is better. But we have deemed dividends because in 1961, 1962, we weren't sure that we have the jurisdiction to tax the CFC on foreign source income. And so we said, okay, we'll have a deemed dividend. Practically, it makes no difference. This was challenged in the court. The challenges were all rejected. And I think fundamentally, it's now pretty well established. There are more than 30 countries with CFC rules. Under the ATAD, every European country needs to have CFC rules. That's a directive. They have to do it. And all of these CFC rules say that the country where a multinational is headquartered has the right to tax the entire multinational on its entire income, subject to the foreign tax credit. And I think, given that, that's their sovereign choice. And if all the G20 agree to this, that's their choice. And you can't complain too much about that, because the solution is, quote unquote, to grow multinationals in other places. And yeah, maybe eventually this will happen, but that's not going to be easy or fast, because growing multinationals is not easy or fast. I mean, there's a reason that, the big multinationals are in a small number of countries. I mean, you can't replicate Silicon Valley very easily in other places. I mean, people have tried. It's not easy.
Thank you, Reuven. I want to conclude by asking the following. If your thesis is accurate, which I have no doubt it is, that Pillar 1 and 2 is, in a way, exporting concepts and ideas that have developed over a long period of time, especially in the United States, to other countries now, are we also exporting the known problems of those interstate sales taxes and the guilty to others?
I mean, sure. I mean, there's no question. It's well known that all of these issues have problems or issues that need to be addressed. There's no such thing as a tax method that doesn't have problems or loopholes that need to be addressed. Like, for example, the sourcing of sales. So one of the classic arguments against it was multinational can put a thin margin distributor between itself and the country of sales. The thin margin distributor will have very small profit margin. It falls out of amount 2A, and multinationals will not be subject because it's not making any sales into that country, and the sales that it's making into a country will be into a tax haven that doesn't tax it. Okay, well, you know, turns out that for various purposes, such as the VAT, but also the income tax, we have many rules in our income tax, in Separate Act, for example, that depend on the tracing of sales. And so there are ways of looking at this, and there are ways of looking through. The reality is that big multinationals, and these are all big multinationals, are unlikely to give up on control of their distribution channels. Or if you just take Facebook and Google, for example, they don't really need to make any sales into a country, but they collect data, and their data collection is itself a piece of data that can be monitored and quantified relatively easy. And they're not going to do that through intermediaries because they really depend on collecting the data themselves. That's how the business model operates. So I don't think that that's too much of a problem, but you know, we need to do things about it. And with Pillar 2, similarly, there are well-known issues about how to do it. And now there's a big debate in the US, for example, whether you do it country by country or whether you do it worldwide with an exception for countries whose tax rate is high enough. They're all kind of technical. And I have no doubt that the next few years will be interesting. I mean, the biggest problem in my mind, actually, just looking at from an American perspective, is that Pillar 1, unlike Pillar 2, I mean, I really think they need to be distinguished. Pillar 1 absolutely requires changes in the treaties because of the PE rule and the arm's length standard. So you need to change Article 7 and Article 9 in every treaty in the world, basically. Pillar 2, yes, there's the subject to tax rule, but fundamentally, it's about residence-based taxation and the income inclusion rule, and that doesn't require changes in the treaties because, you know, the CFC rules are already well established. So Pillar 2 can be adopted by the United States unilaterally. That's what they did in GILTI, basically, and they just need to modify GILTI a little bit, again, unilaterally, and that's not a problem. Pillar 1, because it requires a new treaty, almost impossible to imagine the United States will actually do it because you need to get it through the Senate, which is almost impossible to do these days. People have tried all kinds of ideas of how to do it, but fundamentally, the way I think it will work, that's just nobody knows how to predict the future. My guess is that the rest of the world will sign on to Pillar 1, and the United States will not, but the United States will respect Pillar 1 in the sense that they will give foreign tax credit for amount A is collected by other countries from Amazon, Google, and Facebook, because Amazon, Google, and Facebook will go to the Congress and say, what are you doing to us? We don't want double taxation. Give us the foreign tax credit for this. And we will say, fine, we'll give you the foreign tax credit for this because that's just an executive branch decision. And so just like CRS and just like the Vienna Convention on the Law of Treaties and so many other things, we're not going to sign on to a multilateral agreement that we've brokered ourselves. But nevertheless, it's going to work because the United States, as a practical matter, will go along. And also, if there's a big enough multinational that sells into the US as a market country, we're not going to give up on taxing them on the amount A if we have the right to do that, regardless of what the treaties say. And, you know, yes, we need a new treaty, but it's not, I mean, I'm not sure it can work in the United States, but it can work in other countries, as we've seen before.
Thank you. I think if this all goes ahead into the implementation state, we'll all become students of US tax law in a much greater
to some extent, yes.
To some extent.
That is true.
Thank you very much. It's been highly stimulating. I think I can commend your article to all readers because it illustrates the power of tax history, how actually it's very relevant to make sense of proposals and what's going on around.
There's never anything new under the sun, or as I say, plus ça change, plus ça la même chose. Okay, thank you very much.
Thank you, Reuven.